Hi there, tax accountants. I hope all is well, and I pray that as you viewing this video that you're in the best of health and spirit. This video will cover several questions from Chapter 1, which deals with the individual income tax return, Chapter 2, which deals with gross income and exclusions, and Chapter 3, which deals with business income and expenses. So this first question comes from Chapter 1, the individual income tax return. So this chapter introduces the U.S. individual income tax system. Some important elements of the individual tax formula are covered, including tax calculation, who needs to file a tax return, the various filing status, the difference between itemized deductions and standard deduction. And we also go over some basic steps in this chapter of how to complete a basic Form 1040. So for this first problem, it asks us to match each type of transaction with the form on which it is most likely reported. All right, so as it relates to taxation, there are various forms and schedules that must be completed in order to file someone's tax return. So the most familiar taxable entity is an individual. As we've discussed previously, there are two tax-paying entities, individuals and corporations, and then we have what's called pass-through entities, and that is sole proprietorship, partnership, and S corporation. Those are pass-through entities. So those entities, they do not necessarily file tax returns themselves, but they pass through the income onto the individuals or the corporation. So taxable income for individuals generally includes income from all sources. So that is the definition of gross income. There's no definition by the Internal Revenue Code, but at the very basis of it all, income, gross income rather, is essentially income from whatever source derived. So as a U.S. citizen, if I earn money from overseas, my family is from Guyana. If I earn money in South America, even though I am a U.S. citizen, I still need to report that income. So again, gross income is defined as income from whatever source derived. So most individual taxpayers, they'll either file Form 1040, or for taxpayers ages 65 or older, they'll file Form 1040 SR. So the 1040 and the 1040 SR, they're organized so that some taxpayers, they might only need to use this form, right? So items such as wages, interest, dividends, common deductions, they're reported directly on the Form 1040. But there's some less common items that's reported on supplemental schedules and forms, and then those totals are carried from those schedules and forms to the Form 1040 or 1040 SR. So we have what's called 3 supplemental schedules. We have a Schedule 1, a Schedule 2, and a Schedule 3 that's used for additional income, additional deductions, supplemental taxes, and other credits. And in addition to Schedules 1, 2, 3, we also have certain types of income and deductions that's reported on specific schedules. So Schedule A, that's for itemized deductions such as medical expenses, certain taxes, interest, charitable contributions, and other miscellaneous deductions. Schedule B, that's for interest income over $1,500 or ordinary dividend if it's over $1,500. Schedule C, net profit or loss from a sole proprietor, trade, or business, or a single member LLC that has not elected to be taxed as an S corporation or a C corporation. Schedule D, capital gains and losses. Schedule E, rental, royalty, and pass-through income from partnerships, S corporations, estates, and trusts. And lastly, Schedule F, farm or ranch income. And then there are some additional schedules. I mean, there's a plethora of schedules, but these are, some of the common schedules that are generally used. So for our wages and salaries, these are reported directly on Form 1040. If there's interest that's over $1,500, that's the key thing. If it is less than $1,500, it's reported directly on the Form 1040. But when it is $1,500 or more, it is reported on Schedule B. Capital gains from the sale of stock would be reported on Schedule D. Deductions for charitable contributions would be on Schedule A. For itemized deductions, self-employment taxes would be on Schedule 2. So Schedule 2, the primary purpose is to report additional taxes beyond basic income tax, such as alternative minimum tax, repayment of excess advance premium tax credit. So if you receive a Form 1095A and you need to repay a portion of it, self-employment taxes and household employment taxes are examples of those additional taxes. Rental income would be reported on Schedule E, and the primary purpose of Schedule E is for rental, royalty, and pass-through income from partnerships, S-corps, estates, and trusts. Credit for child and dependent care. This would be reported on Schedule 3. The purpose of Schedule 3 is for credits and payments other than withholding. This includes education credits, residential energy credit, any estimated tax payments that have been made, any excess Social Security taxes. Those are examples of credits and payments that are reflected on Schedule 3. Net profit from a sole proprietorship, Schedule C, and as mentioned, Schedule C is also used for single member LLCs that have not elected to be taxed as a C corporation or an S corporation. And lastly, deductions for gross income would be reported on Schedule 1. And the primary purpose for Schedule 1 is to account for additional forms of income other than wages, interest, dividends, distributions from qualified retirement plans, Social Security benefits, and capital gains or losses. In addition, Schedule 1 also accounts for many deductions to calculate adjusted gross income. So for this problem, it asks us about the standard deduction. It says, mark each statement below as either true or false regarding the standard deduction and the itemized deduction. So just to give you a brief background, the standard deduction was placed in tax law basically to help provide relief for taxpayers, right? Because we have what's called itemized deductions, and itemized deductions, that is essentially personal expenses that are allowable as deductions per the Internal Revenue Code. So not all personal expenses are deducted. However, there's a specific set of personal expenses that Congress has allowed as tax deductions, and included in this category, there's medical expenses, there's certain interest expenses, there's certain taxes, charitable contributions, casualty losses, and other miscellaneous items. But in certain instances, let's say someone is not a homeowner, so they cannot claim mortgage interest deduction or real estate taxes, or someone doesn't pay a lot in state taxes, or they don't pay a lot to charitable, charities, 501c, corporations, organizations rather, whereby they can get the benefit of deducting it. So the purpose of the standard deduction, again, it was placed in tax law to help provide relief for taxpayers with few itemized deductions. And the amount of the standard deduction is subtracted from adjusted gross income by taxpayers who do not itemize their deductions. So a taxpayer takes one of the two. It's either they claim itemized deductions or they claim the standard deduction. There are certain scenarios where a taxpayer would be forced to take one of the other. Like for example, if a client is married filing separate, both spouses need to use the same deduction, whether it is either itemized or standard. But with the exception of those, little nuances, individuals take the standard deduction or the itemized deduction, whichever would help to minimize their tax liability. So A states the standard deduction is an amount that varies with filing status. This is true. The standard deduction, it does vary based on your filing status, your age, and your vision, but it is not by amount that varies with the filing status. So just keep that in mind. B, a taxpayer should claim the smaller of the standard deduction or the total allowed itemized deductions. This is false. The taxpayer should claim the larger of the standard deduction or the total allowed itemized deductions. Because again, the key thing is that with the itemized deductions or the standard deduction, it helps to reduce the taxpayer's income that's subject to tax. So as a taxpayer, you want to pay the least amount of taxes possible. Hence, you claim the greater of the two. C, total itemized deductions depend on the amount and type of items, with some items having limitations based on AGI. This is true. Total itemized deductions is mentioned. It represents personal expenses that Congress has allowed as tax deductions. However, there are certain itemized deductions that have limitations based on adjusted gross income. This includes medical expenses, certain taxes, certain miscellaneous expenses. They are limited based on adjusted gross income, aka adjusted gross income. D, taxpayers who are 65 years of age or older or blind are entitled to an additional itemized deduction amount. This is false. Taxpayers who are 65 years of age or older or blind are entitled to an additional standard deduction amount. So here it says an additional itemized deduction amount. So that's what makes this false. So if they are 65 years of older or blind, they're entitled to an additional standard deduction amount. And for 2023, the additional standard deduction amount is $1,750 for unmarried taxpayers and $1,400 for married taxpayers and surviving spouses. So let's say a taxpayer is 65 years of age or older and blind, they are entitled to 2 additional standard deduction amounts. So just keep that in mind. This question, it says, for each of the following taxpayers, indicate the filing status for the taxpayers for 2023 using the following legend. So for case A, well, before we get there, let's actually discuss these filing statuses, right? At the very least, I've been practicing taxation for over 14 years, and this is something that you are going to always see every tax year. Every tax year, you're going to have to meet with a client, because obviously things change from year to year, and you want to determine at the very least, what is the taxpayer's filing status? This is like one of the starting points. So an important step in calculating the amount of the taxpayer's liability is determining their correct filing status. Why is this so important? This ultimately determines the amount of their tax liability. So the tax law has 5 different filing statuses, as we see here. The first is single. Single, that's basically someone who does not meet the definition of married. They are not a surviving spouse, and they are not head of household. Next, we have married filing a joint return. So if you are married as of December 31st of the tax year, you are considered married. So if an individual, got married on December 31st, even though they were only married for a day or a couple of hours, for tax purposes, they are considered married for the entire year. Married filing separate, married taxpayers, they may decide they want to file separate tax returns. So there's different scenarios, right? Sometimes people are just married by law, but they're living separate lives, or one taxpayer might work a really big job and the other doesn't. So there's various reasons, but married filing separate, you were married, and for whatever reason, you just don't want to file with your spouse. Next, we have head of household. This is if an individual is unmarried or qualifies as an abandoned spouse, which I'll discuss a little later, but an unmarried taxpayer and they have a dependent, a qualifying child or qualifying person, right? Which we will discuss a little later. But the key thing is qualifying person, qualifying relative, and the individual is unmarried, but they have a dependent, someone that they are taking care of. Then lastly, we have the surviving spouse. And this is essentially when a taxpayer, their spouse passes away, they get the benefit of still claiming the tax rates as though they were filing a joint tax return after the death of the spouse. And the key thing is that they must have a qualifying dependent. So we'll look at all of these. A states Linda is single, and she supports her friend Kayla, who has no income, including paying all costs of Kayla's housing and an apartment across town. So in this case, we need to determine, should she be head of household? She has a dependent, Unfortunately, no, right? And the reason why this would be no, someone might be looking at this and thinking, hey, well, her friend Kayla's basically a dependent. You know, she's paying all of her expenses. But one of the key things as head of household is that the taxpayer paid more than, half of the expenses for the upkeep. In addition, they kept the home was the principal place of residence. In this case, we see that Kayla lived in an apartment across town. So therefore, Kayla, her friend, does not qualify. Therefore, Linda is single. B says Frank is single and claims his unrelated significant other as a qualifying relative as the significant other lives in the home Frank pays for and the significant other has no income. So keep in mind, as it relates to head of household, right? Now it kind of, ties into who is considered a qualifying dependent and who is not. So in order to determine, who's a qualifying dependent or not, the key thing, well, we know first and foremost that the significant other is not a child. So they wouldn't fall under what's called a qualifying child. So there's two things. We have it's a qualifying child, and then we have a qualifying person or a qualifying relative. So for a qualifying child, the first key thing is that there's several tests that must be met. There's 4 tests for a qualifying child. First, there must be a relationship test. It should be the taxpayer's child, stepchild, adopted child, the taxpayer's brother, sister, half brother, half sister, step sibling, or descending of any of these. The significant other is none of those. There must be a domicile or an abode test. And that simply means that the potential qualifying child must have the same principal place of abode. They must live there for more than half of the taxable year. The third test is the age test for a qualifying child. The qualifying child should be under the age of 19 or a full-time student under the age of 24. And then lastly, the self-support test. A potential qualifying child should essentially receive more than half of their support from the taxpayer. Now, if someone doesn't qualify as such, they might still be considered a qualifying relative. So a person who is not a qualifying child may be a qualifying relative and thus claimed as a dependent. So the potential for depending or determining rather, if an individual is a qualifying relative, they have to meet the first 4 tests of all the dependents outlined earlier. So they can't be claimed as a dependent and a potential qualifying relative. They can't file jointly with someone else, and they must be a U.S. citizen or resident. So here we see significant other, right? We know for sure it cannot be a qualifying child. So there's a relationship test. So there's some exceptions for the qualifying relative. Therefore, it can include children, stepchildren, parents of an ancestor. Keep in mind, cousins, do not account. So any individual that does not meet the relationship test, they cannot be considered a qualifying relative. The same thing for the domicile abode test. The individual needs to have lived in the home for the entire year, right? One exception is if it is a parent that you are taking care of. Next, there's a gross income test. The qualifying relative cannot have gross income that's equal to or above $4,700 in 2023. And then a support test, the dependent must receive more than half of the support. So because this is a unrelated significant other, unfortunately, even though Frank is taking care of everything, he cannot claim the significant other as a dependent. He is single. Here it says Arthur is single and he supports his 30-year-old brother who lives in Arthur's home. So based on this fact pattern, it's either A or D. He might be single or he might be head of household. The key thing is we need to look at the rules for the qualifying relative to determine whether or not Arthur will have to file as single or head of household. D, Leslie's spouse died in 2023. She has no dependents and did not marry. So based on this, the spouse died in 2023 and the problem is asking us what we should file for 2023. So therefore, the answer is B or C. She can choose to file a married filing joint return or choose to file a married filing separate return in 2024. she would not be able to use the surviving spouse qualifying widower because there are no dependents. E, Lester's spouse died in 2022. He has one 17-year-old dependent child that lives with him in the home that Lester pays for. So this one is a little tricky, right? So Lester can file as single. Lester can also file as head of household or surviving spouse, right? So for this 17-year-old dependent, and then we see Lester's spouse died in 2022, the year prior. So these are the three filing statuses for which Lester can potentially choose. Maybe this 17-year-old dependent still lives in the home, but maybe they have a full-time job where, Lester is not providing more than one half of the support for the child, right? So there's a lot of different things. That's why, at the very least, when you're preparing tax returns, you need to ask probing questions to clients to make sure that you choose the correct filing status. So this ties into what we were just discussing. There's two types of dependents, either qualifying child or a qualifying relative. The answer is true. And this problem, it asks us, each of the following taxpayers has 2023 taxable income before the standard deduction is shown. Determine from the tax table provided the amount of the income tax before any credits for each of the taxpayers for 2023. So it is very important for us to keep in mind what we're going to make a spreadsheet with this. It's very important for us to remember what the standard deduction is. It doesn't mention anything about itemized deductions, but here we see taxable income before the standard deduction. So what that simply means is that before we can get to determining the taxable income, we first need to subtract the standard deduction. All right, so we're going to get that Excel set up so we can work through it. All right, so here we are. And this is going to help us again to, get a better understanding, because a lot of times we use the tax software, and the tax software basically just, does all of the work for us. But you want to be able to understand the nuances of what is happening behind the scenes, because if the taxpayer comes to you and they ask you a question like, hey, why is my my refund not so large, or why do I owe so much money? You want to be able to explain to the taxpayer how it works, how these amounts are calculated and determined. So it is not enough to just rely on the tax software. So taxable income before the standard deduction. All right. So here we see this. All right, we're gonna merge this a bit. Make it a little pretty. All right, so here we go. So the taxable income before the standard deduction. And again, how do we determine the standard deduction? Is we learned in the previous problem, it is ultimately based on the taxpayer's filing status. So I'll make a new column, standard deduction. All right, so for the standard deduction for a single individual for 2023, that amount is $13,850. So again, just keep in mind, this is basically an amount of money that the IRS allows you to keep tax-free. So for me, that's an easy way to explain it. Again, it essentially provides relief for those who do not claim itemized deductions. So here we get the taxable income. All right, so in order to determine for Alan his taxable income, it is the taxable income before the standard deduction. And again, for 2023, it is $13,850. So the taxable income is $22,150. So we use the tax tables. And then we see that the taxable income, it says if taxable income is at least but less than, and you are, your tax is. So his taxable income is 22,000. So we scroll down, we need to get to the 22,000 section. All right, here we are. So for Alan, we see that the first column is a single individual. So his taxable income is $22,150, right? And he is single. So therefore, his tax liability is $2,441. Tax liability. All right. So now we do the same thing for Boyd. So Boyd is married filing separate, and for a married filing separate individual, the standard deduction is same as single. It is $13,850. So taxable income before standard deduction of $38,200 minus $13,850. Taxable income of $24,350 for Boyd. So here we see we're, right on the same chart, 24,350 for a married filing separate individual. We see here tax liability is $2,705. All right. This brings us to the next individual, Codwell, filing as married, filing joint. So for Codwell, taxable income before standard deduction of $64,000, and the standard deduction for a married filing joint couple in 2023 is $27,700. So our taxable income is $36,320. So we go to the tax table, 36,000. And the range falls between 36,300 and 36,350. Married filing joint. So we basically connect the dots. The tax liability is $3,919. For Dell, taxable income before the standard deduction of $50,922. The standard deduction for a head of household for 2023 is $20,800. That gives us taxable income of $30,122. So $30,122, we fall between the $30,100 to $30,150 range. So as head of household, we connect the dots. The tax liability is $3,301. So this brings us to the last individual, Evans. The standard deduction for a single individual is $13,850. So taxable income of $45,000, we scroll down. So $45,153, so it falls within the range of $45,150 to $45,200. So therefore, the tax liability for Evan as a single individual is $5,246. All right, so again, the tax software will calculate all of this, but you want to be able to understand it, because if the client comes to you with questions, you want to be able to explain to them why their tax liability is such, why their refund is what it is, or why their balance due is what it is. So this brings us to a similar question. It's asking us to calculate the following amounts. Calculate gross income, adjusted gross income, aka AGI, the itemized deduction or standard amount, taxable income, and the income tax liability. So here it says Brock, age 50, and Erin, age 49, are married with 3 dependent children. They file a joint return for 2023. Their income from salaries total $52,000, and they receive $8,000 in taxable interest, $5,000 in royalties, and $3,000 in other ordinary income. Brock and Erin's deduction for adjusted gross income amount to $2,750. and they have itemized deductions totaling $28,000. All right, so one thing I want you to keep in mind, this is the income tax formula. So we start off with our gross income. We subtract deductions from adjusted gross income, and this gives us our adjusted gross income. From there, we subtract the greater of our itemized deductions or standard deduction. From there, we subtract qualified business income deduction, if any, and this gives us our taxable income. From there, we multiply it by the tax rate using either the tax table or the rate schedules, and we just use the tax table. That gives us our gross tax liability, and from there we subtract tax credits and prepayments, and that determines our tax due or refund. So no matter how simple or how complex a tax return is, this is the formula that governs taxes due or refund to taxpayers. And for corporations, it's fairly similar with a bit of nuance as it relates to limitations and deductions and certain things. But for the most part, this is the formula for individual income taxes. All right, so in order for us to determine the AGI in this problem, we would approach it as such. So we get this pulled back up. So here we see it's a little smaller. Sometimes the visual makes it easier versus just saying the amounts. So we start off with salaries. And the problem lets us know that there are salaries of $52,000. And then from there, we also have some interest income. We have some royalties. So we determine our interest income of $8,000. It lets us know that it's taxable. We have royalties of $5,000. And then it lets us know that we have other ordinary income of $3,000. All right, so we know the definition of gross income is income from whatever source derived unless it is specifically excluded from income. So here we have our gross income. Now the next step is for us to subtract and deduct any deductions for AGI. So the problem lets us know that deductions for AGI amount to $2,750. All right, so amount to $2,750. So now the next thing is that we need to account for our adjusted gross income, aka AGI. All right. So in order for us to determine our AGI, it is our gross income minus our deductions for AGI. We'll actually need to sum it. So our adjusted gross income in this case is $65,250. So we need to determine, are we going to claim the itemized deductions or are we going to claim the standard deductions? So in this case, the problem lets us know they have itemized deductions totaling $28,000 versus standard deduction for a married couple of $27,700. So I want to use this problem and this opportunity to actually show you the key difference between claiming the standard deduction versus the adjusted gross income. Right? So this first example would be itemized deductions. And the second example would be standard deduction. So that way you guys can see side by side the benefit of choosing the greater of the two. And again, we are not considering those nuanced situations where the individual has to claim the other. or has to claim the same thing when they are, like married filing separate. All right, so in this case, itemized deductions total 28,000, married filing separate or married filing joint rather, standard deduction is 27,700. So in this case, the greater of the two, less is itemized deductions is greater than the standard deduction. So we subtract 28,000, and this gives us our taxable income. All right, so based on this information, taxable income will be 37,250, and we use this to determine our tax liability. So these are the numbers that we're going to input, into the program. It asks us for gross income. We calculated that. It asks us for adjusted gross income. We calculated that. It asks us, are we claiming itemized deduction or the standard deduction amount? And what I'll also do, so this would be A, this would be B, this would be C, D, and E. So that where you can, clearly see how this correlates to a problem. So now for us to determine our tax liability, the taxable income is 37,250. So it's similar to what we did for the previous problem, 37,250. So we fall here at least 37,250, but not more than 37,200. So therefore, as a married filing joint couple, this would be our bracket. We basically connect the dots. So therefore, our tax liability would be 4,033. All right, so now let's say that, the individual took the standard deduction. So the standard deduction for a married couple, as we know, is 27,700. And again, this is just for example purposes. So you see the benefit of taking the greater of the two. So less standard deduction. All right, so based on this, the taxable income will be $37,550. So going back to the table, 37,550. So we're at least 37,550, but less than 37,600. So our tax liability would be 4,069. So again, this is a small difference, but imagine if you're dealing with hundreds of thousands of dollars. So again, that is why we take the greater of the two. We take whichever is going to reduce our tax liability. So in this case, we see we claimed the itemized deductions of 28,000 because it was greater than the standard deduction, which was only 27,700. Our taxable income was 37,250, which gave us a tax liability of 4,033, versus if we claimed the standard deduction, which left us with a taxable income of 37,550 and a tax liability of 4,069. All right, so these are our answers. Gross income of 68,000, adjusted gross income of 65,250. We claimed itemized deductions of 28,000. Our taxable income was 37,250, and using the tax table, our tax liability was 4,033. All right, so this brings us to our next question: salaries and wages. It states annual wages are annual wages subject to income tax are reported where? So as an employee of a business, this is one of the most common ways to earn income in the United States of America. And as an employee, the primary form of reporting wages to employees from employers is Form W-2. So an employee receives the Form W-2 from the employer, and it provides information about the wages that they've earned during the year. in addition to taxes that were withheld, other benefits and things of that nature. So with our form W-2, we'll show you an example. All right, so this is from the IRS site. Here we see an example of a form W-2. So it could be, payroll can be processed from ADP, paychecks, QuickBooks, really doesn't matter. At the very least, this is what the W-2 is going to look like. Box B shows the employer's identification number, and the employer's identification number, the EIN, is basically similar to an individual's social security number. C, the employer's name, address, and zip code. D, the control number. E, the employee's first name and initial, as well as their last name and suffix, if any. F, the employee's address and zip code. And then we have several numbered boxes. Box 1 shows the taxable wages, tips, and other compensation. Box 2 reports the amount of federal income taxes that have been withheld from the taxpayer's wages and remitted to the IRS, the government, by the employer. Boxes 3 through 6, these report information related to the amount of wages that's subjected to Social Security and Medicare employment taxes, as well as the related taxes withheld. So keep in mind, the amounts that's reported on these boxes, they don't necessarily impact the return. One key thing to keep in mind is that box 1, box 3, and box 5, they often agree, right? So if it's 1,000 in box 1, it'll show 1,000 in box 3 and 1,000 in box 5, but sometimes there are differences. The key thing to keep in mind is that box 1 represents the taxable wages, and this is the line amount that is transferred to the Form 1040. If there's multiple W-2s, then the total of all line 1s for those W-2s would be transferred to the Form 1040. All right, so just keep in mind, boxes 3 and 5 on a W-2 might be different from box 1. So for those of you who do decide you want to venture and pursue taxation, box 1, 3, and 5 might not always be the same. But annual wages subject to income tax are reported on. The correct answer is C on W-2, Form W-2, box 1. Here it asks for the distinction between qualified dividends and ordinary dividends. So what is the difference between the two? So when we have dividends are basically, a type of distribution paid to a shareholder by a corporation. So as corporations, they can issue shares of stock. And for individuals that buy these stocks, they are considered shareholders. They are owners. They are making investments into the company. And for investing, certain corporations, they issue what's called dividends. So taxpayers, they receive the following types of distributions from a corporation. It could also be from a mutual fund or a similar investment that owns these corporate stocks. So they can get ordinary and qualified dividends, non-taxable distributions, in addition to capital gain distributions. So ordinary dividends, these are generally, the more common type of corporate distributions. They're paid from earnings and profits from the corporation. And ordinary dividends are also considered qualifying dividends if the stock is held for a certain amount of time, and generally 60 days, and the dividend is issued by a U.S. corporation. So if the ordinary dividends are not qualified, then it's being taxed at the ordinary tax rate. So that's one key thing to keep in mind. Ordinary dividends are taxed at ordinary tax rates versus qualified dividends, which are taxed at a preferential tax rate. So that's one of the benefits of qualifying dividends. They are taxed at a preferential tax rate. So the correct answer is qualified dividends are taxed at a preferential rate and are a subset of ordinary dividends. Here it asks us about Social Security benefits. And it's saying for 2023, the maximum percentage of Social Security benefits that could be included in a taxpayer's gross income is. So some taxpayers, they may exclude all of their Social Security benefits from gross income. However, most middle income and upper income Social Security recipients, they may have to include up to 85% of their benefits in gross income. So there's a specific formula, which is called calculating the provisional income. So this is calculated as follows. It is the individual's MAGI, which is the modified adjusted gross income, without considering any Social Security benefits, and then you add back any tax-free interest income, and in certain rare circumstances, they might also have to add back unusual items such as the foreign earned income exclusion, any employer-provided adoption benefits, or interest on education loans. And if your modified adjusted gross income plus 50% of your Social Security benefits is less than the base amount, then benefits are excluded from income. But if it falls within a certain range, then your Social Security benefits could either be taxed at 0% if it's less than the base, 50% if it falls within the range, or a maximum of 85% if it exceeds the range. Now here for this question, it asks to respond to the following. In 2023, how are qualifying dividends taxed? So as mentioned, qualifying dividends, they are taxed at a preferential rate. And here it's asking, how are they taxed? Is it 0 or 15? Key thing is that it is ultimately dependent on what the individual's income level is. And based on that, it can either be subjected to 0%, 15%, or 20%. And again, it's depending on the income and the filing status. So one of the reasons being is that the challenge is, as we mentioned a little earlier, corporations are considered a tax-paying entity, right? So corporations, let's say they have $50,000 of taxable income, they pay taxes on the $50,000. Now the corporation pays dividends to individuals out of their earnings and profits. So now what happens is that when the individual received dividends, the shareholder has to report taxes on the dividends received, and now they're paying taxes on the dividends received. So one of the challenges is that there's double taxation for a corporation. So in order to, help with that, to provide some relief for individual taxpayers who receive these corporate dividends, the tax rates on qualifying dividends are the same as long-term capital gains, which are, again, preferential, and they're lower than the rates for ordinary income, and it's 0%, 15%, or 20%. So B asks us to complete the following paragraph that outlines the tax rates and application for qualifying dividends. So for a single taxpayer with a taxable income of blank or below, they would have capital gains taxed at a rate of 0. So single taxpayer with taxable income of $44,625 or below, they would have capital gains taxed at a rate of 0%. If that same single taxpayer's taxable income was over $44,625 and up to $492,300, the capital gains rate would be 15%. And if the taxpayer made over $492,300 of taxable income, the capital gains rate would be 20%, right? So again, the benefit of qualified dividends is they are taxed as long-term capital gains. Single individual, obviously, if you are married filing joint, then it's a bit different. Head of household is a little different. But again, the key thing is that there are 3 ranges, either 0%, 15%, or 20%. And then lastly, it says, in addition, certain high income taxpayers may also need to pay an additional 3.8 Medicare tax on their net investment income. All right, so this is a new thing that was essentially included in the tax law, where individuals, when they have certain income, so we call them HNW, high net worth clients, when they earn certain income, they also need to pay an additional 3.8 Medicare tax on their net investment income. All right, here it asks, which of the following factors are important in determining whether an individual is required to file an income tax return? All right, so one of the key things that determines if an individual needs to file a tax return is the taxpayer's filing status as well as their gross income, right? So that's one of the key things. You need to determine, does this person even need to file? So, there's a series of things that you will essentially ask them to be able to determine whether or not they actually need to file. So there are several conditions that must exist before a taxpayer is required to file U.S. income tax return. And again, the key thing is that these conditions primarily relate to the amount of the taxpayer's income, as well as the taxpayer's filing status. So the correct answer is C. For this question, it asks, for an activity to be treated as a trade or business, which of the following is required? So as we know, in chapter 3, it essentially deals with business income and expenses. And one of the key things with a trade or business, the term trade or business is not formally defined by the IRS. However, right, it's often used in the Internal Revenue Code. So with a trade or business, this for tax purposes is essentially an activity that is engaged in for profit. Keep in mind, the individual doesn't necessarily need to make a profit every year. Generally you start out a business, the first few years, you might not have a profit, you might suffer some losses. It's part of business, but for the most part, the key thing is that you have a regular and continual effort designed to seek profit. So the correct answer is A, but we'll go through the others. It says guaranteed generation of profit. No one can guarantee profit, right? Things happen. Look at COVID. Who could have anticipated something like that happening? So imagine someone started a restaurant a few months or a year before COVID happened. They could not have foreseen such a circumstance, right? Restaurants being shut down unless it was essential. Organization as a corporation or partnership, no, that's not true. There's various structures for a business. It might be a sole proprietorship. Maybe it is a LLC. It could be a single member LLC with one individual, or a multi-member LLC with two individuals. All right, so does not need to be a corporation or a partnership. No more than intermittent effort toward the activity. No, you need to be actively engaged in the business. So A is the correct answer. Next question states, what is the amount of Nia's deduction for business gifts? Nia owns a small dress store. During the year, Nia gave business gifts to the following individuals with the costs as indicated. Miss Green is a customer. Mr. Green, who is a non-client husband of Mr. Green, a gift was given of $10. Miss Brown, a customer, a gift was given of $22. All right, so within limits, taxpayers are allowed a deduction for business gifts. So salespersons and other taxpayers, they are allowed to deduct a maximum of $25 per year per donee. And for purposes of this limitation, spouses, they count as one donee, right? So one key thing to keep in mind as it relates to the limitation with spouses, that's if the spouse is also a client, right? So you want to essentially keep that in mind. Is the spouse also a client? So in this case, we see Ms. Green, a customer, and then Mr. Green, who is the non-client husband of Mr. Green. Unfortunately, the $10 that was given to Mr. Green doesn't count, right? Because they essentially count as one. Keep in mind, shipping, that is essentially considered an additional expense, but the gift of itself is limited to that $25. So therefore, the calculation for the gift would be as follows. Miss Green and Mr. Green, they are husband and wife. So the limit would be $25 plus the $3 for shipping, and Miss Brown, who is a customer, $22. Keep in mind, it's not for every client you get to claim $25, right? In this case, we see that for Ms. Brown, Nia gave a gift of $22, which is below the maximum. So we take the maximum, but let's say a gift was given to Ms. Brown of $27, only $25 would be considered deductible. So do the calculation again. Miss Green and Mr. Green, because Mr. Green is not a client, For tax purposes, spouses count as one donee. Thus, the maximum that a taxpayer could deduct for gifts to a client or potential client and their spouse is the total of $25 per year, unless the spouse is also a client. And in that case, then the spouse can receive a separate $25 gift. But in this case, Mr. Green is not a client. So for both Mr. Green and Miss Green, the maximum gift is $25. We add the $3 for shipping, and then we add the $22 for Ms. Brown. The amount of Nia's deduction for business gifts is $50. This question asks, what amount of these expenses can be allocated to his home office? It says Edgar is a mental health counselor who uses a portion of his home office, using a portion of his home as his home office. His home is 2,500 square feet, and his office space occupies 1,500 square feet. Rent expense is $18,000 a year. Utilities expense is $2,000, and maintenance expenses are $3,000 a year. So some taxpayers, they operate a trade or business in their home, therefore they qualify for the home office deduction, right? But keep in mind, the tax law does impose some strict limits on the availability of this deduction. But as we look at this fact pattern, one of the basic things for us to keep in mind is, well, what is the percentage of the home office? So the home office is 1,500 square feet, and his home is 2,500 square feet. So therefore, the home office represents 60% of the home. So we just calculated the square footage, a percentage, and just keep in mind when this form is filed, we utilize what's called Form 8829. So we have some indirect expenses, right? $18,000, which represents the rent expense for the entire year. $2,000, which represents utilities expense for the entire year, and maintenance expense for the entire year. So total expenses equate to $23,000. However, the home office only utilizes 60% of the home. So therefore, the deduction that is allowed is $13,800. So keep in mind, there are some limitations based on net income, or the tentative net profit rather. But in this case, it's just asking us what amount of these expenses can be allocated to the home office. How much is allowed to be deducted for the year is ultimately based on the tentative net profit, which is calculated on Schedule C. All right, so to that point, we're going to look at this example, and it is going to show us, you know, the importance of the tentative net profit, which determines the amount of home office expenses that can be deducted. So here it says, assume that Cindy earns income of $4,400 from her business from the year before deducting home office expenses. She has no other expenses associated with the business. So here we see depreciation of $1,500, utilities of $500, real estate taxes of $325, mortgage interest of $500, for a total of $2,825. So in this example, we see that there's total home office expenses of $2,825, and she earns income of $4,400. So with the limitations mentioned, the home office deduction, it cannot reduce net income from the business below zero, except for home mortgage interest and property taxes applicable to the office, which are generally, you know, they're tax deductible as an itemized deduction anyway. But anything else, with the exception of those two, they cannot reduce the net income from the business below zero. So her home office expenses are $2,825. The tentative net profit is $4,400. So therefore, Cindy can claim the full home office deduction. But now for this next scenario, it's asking, assume that Cindy earns income of $2,600 from her business. So because her tentative net profit is $2,600, this represents the maximum amount that Cindy can deduct for the year. So you might ask yourself, okay, total expenses were $2,825. She can only deduct $2,600. How much, or what happens rather, to this $225? In such case, This $225, it is not a lost cause. It is going to carry forward to a future year. So this brings us to our last problem. We're going to complete our own Schedule C. So we have Schedule C, transportation, meals and entertainment, dues, subscriptions, and publications. It states Scott Butterfield is a self-employed CPA. He uses the cash method of accounting, and his social security number is 644-477833. His principal business code is 541211. Scott's CPA practice is located at 678 3rd Street, Riverside, California, 92860. Scott's income statement for the year shows the following. So we have income statement for the current period, January 1st, 2023 to December 31st, 2023. And then we have a comparative statement for the prior period, January 1st, 2022 to December 31st, 2022. All right, so we have all the information here. Revenue, cost of services, which includes salaries, payroll, supplies, and then we have all of our operating expenses, which gets us to our net income or loss. In addition, there's also some additional information. It says the expenses for dues and subscriptions were his country club membership dues for the year. There's $400 of charitable contributions that were made to a political action committee. Scott does not generate income from the sale of goods and therefore does not record supplies and wages as part of cost of goods sold. Scott placed a business auto in service on January 1st, 2020 and drove it 4,000 miles for business, 3,250 miles for commuting, and 4,500 miles for non-business purposes. No business expenses for the car are included above. Scott wishes to use the standard mileage method. His wife has a car for personal use. And then it states meal and entertainment expenses include $2,500 related to golf, greens fees for entertaining clients, $1,000 for business meals provided by restaurants, and $900 for the bagels and donuts once a month for all employees. All right, so there's a lot of information that's going on in this problem. So we're going to try to get a screenshot of this so we can see all of the revenues and the expenses. And then we're going to go through this information so we can determine how the Schedule C would be calculated or reported if it were. We're going to make this a little smaller. And we're going to scroll down. We're going to start to complete the Schedule C. So here we have the profit and loss. And again, we have the information here. Scott Butterfield is the name of the proprietor. We have his social security number. We have the code from the instructions. The business address is asking for the accounting method. Did he materially participate? So we start off with part one, which details our expenses. So we input our total expenses. In this case, our expenses represent $136,000, which comes from tax services, accounting services, and other consulting services. So we have income of $136,000. Line 3 asks us to subtract line 2 from 1, but there's no returns and allowances. So line 3 is $136,000. Line 5 asks us for our gross profit. There's no cost of goods sold, as it lets us know in the problem he provides services and not products. And then lastly, for line 7, this is our gross income, follows the same fact pattern. There's nothing for us to subtract. There's no other income, including federal and state gasoline or fuel tax credit or refund. So lines 1, 3, 5, and 7 represent our revenue. Next for 8, we start to look at the fact pattern. And what I like to do, especially even in the profession, is when I am finished with a number, I cross it out. So that way I can make sure I input it and I'm not missing that number. So we cross out that 136,000. Next, we input advertising expenses. Some of these are in, order. So the 250, we cross that out. And then we can just go through the line. So insurance is 900. We cross that out. Next, we have office expenses of 200. You can do this in any order, but Next we have rent. And we have office rent of $12,000. Our supplies, as previously mentioned in the problem, let's see. Scott does not generate income from the sale of goods, so he doesn't record supplies and wages as cost of goods sold. So for our supplies, it'll be a 1,302. For 23, the taxes and licenses, the amount would be, all right, we'll need to do an additional calculation for this, so we'll come back to this. I just want to utilize the numbers where we already are just using the final numbers that are there. Next, we move on to travel. Here we have travel. So travel of $900. And again, you can do this in any order. Next, we have our utilities. There's utilities of $3,000. Next, we have our wages. And our wages, as we see here, are $34,000. So we cross that out. And then here we see for our taxes and licenses, how do we determine the amount? So here we see, I'm going to put it in a different color. We have payroll taxes of $3,021. Then we have business licenses and permits. So we add both of these amounts. Generally, what will happen in the tax software is that if you click on this, you can input two lines. The first line will show payroll taxes with the individual amount. And the second line, the business licenses and permits. And we add the two. That gives us $3,321. Next, we look at the meals. So one key thing to keep in mind is that with our meals, we are only allowed to deduct 50% for meals. Not all meals are considered deductible. And again, if we scroll up in the problem here, it shows us 4,400. So someone might be quick to just take the 4,400, but we need to know exactly what's happening in the problem, right? So here it says meals and entertainment expense includes $2,500 related to golf greens fees for entertaining clients, $1,000 for business meals provided by restaurants, and $900 for bagels and donuts once a month for all employees, right? So of this fact pattern, there's certain things that are not considered deductible. We need to determine what is the deductible amount. So with the changes in the Tax Cuts and Jobs Act, anything for entertaining, amusement, recreation, it is not considered deductible. So therefore, of this $4,400, we're going to make this pink. Of this $4,400, only $1,000 for business meals provided by restaurants and $900 for the bagels and donuts are considered deductible. So we can do it two ways. We can do 1,000 plus 900, which gives us 1,900, or we can take the total amount, which is reported on the income statement, 4,400, and subtract the amount that is not deductible for entertainment. So 4,400 minus 2,500 gives us the same 1,900. And we know that meals are subjected to 50%. So therefore, the deductible meals would be $950. All right, so next we move on. There are some expenses that are not reported on Schedule C. So for Schedule C, charitable contributions would not be reported on Schedule C. Instead, it would be reported on Schedule A. The problem also lets us know that there were political, contributions. Those are not considered deductible. All right. So in the event that, it was to a 501c3 qualifying organization, it would be deductible on Schedule A, but political contributions are not considered deductible. So just keep that in mind. All right. So next we move on and we, see what else needs to be deducted. Let's see if we're missing anything else. So we start to factor in the other expenses. We'll come back to the car and truck expenses. So here we have continuing education of $500. And then next we have printing of $50. All right, and from there, we, essentially look at the other expenses. So we scroll up and we look at all of the information that we have here. So we have the $250 for advertising up in, for office expenses, we would also include that postage and delivery. So for the office expenses, it will be the $200 plus the $100 for postage. I'm actually going to change this since we added both. Well, it requires me to remove all, so I'm just going to change the color. So we have $200 for office expenses and then $100. So line 18, we would add both the office expense and the postage and delivery. And then lastly, for the dues and subscriptions, unfortunately, the dues and subscriptions are not considered deductible. All right. So that is something, very important to keep in mind as we are dealing with, Schedule C. Certain things are considered deductible, but unfortunately, some are not. Right. So as it relates to the dues and subscriptions, these are essentially not considered deductible. All right, so now we need to scale back to determine what's the amount of car and truck expenses that would be deductible. So the problem lets us know that he drove 4,000 miles for business. So in order to determine the amount that is deductible, 4,000 multiplied by 65.5. So therefore, the total amount that is deductible for car and truck is 2,620. So just keep that in mind. Again, the standard mileage rate per the IRS is 65.5 cents for a total of $2,620. And let's say, again, and it's always going to be that rate. That rate is determined by the IRS. So you just want to keep that in mind. All right. So we total up our expenses, our other expenses, 550. When did we place this vehicle in service? Per the fact pattern, it was 01/01/2020. The business miles were 4,000. The commuting miles were 3,250. And the other miles were 4,500. And if you ask, hey, where did you get that information? We scroll up, it shows the information here. Scott placed the auto in service January 1st, 2020, and drove it 4,000 miles for business, 3,250 miles for commuting, and 4,500 miles for non-business purposes. All right, so we answer the rest of the questions. It's asking, was the vehicle available for personal use during off-duty hours? Yes. Do you or your spouse have another vehicle available for personal use? Yes. Do you have evidence to support your deduction? Yes. And if yes, is the evidence for it? The answer is yes. So again, all of this is based on the fact pattern up above. So we're almost finished with our Schedule C. Now the next step is for us to total up our expenses. So we have $250 for advertising, $2,260 for car and truck, $900 for insurance, $300 for office expenses, which represents the $200 in office expense plus the $100 of postage and delivery, plus $12,000 in rent, plus $1,302 for supplies. Our taxes and licenses, which is a total of our payroll taxes of $3,021, plus our business licenses and permits. We add the $3,321, plus $900 for travel, plus $950 for deductible meals, plus $3,000 for utilities, plus $34,000 for wages. And then we factor in our other expenses down below, which is $550. We transfer this amount over. So our total expenses are $60,093. So the next step is for us to determine our tentative net profit. And our tentative net profit is our gross income of $136,000 minus our total expenses of $60,093. So therefore, the tentative profit is $75,907, right? So in the previous problem, the reason why this tentative profit is important is because it ultimately determines how much is deductible for our home office. So we see on line 30, it asks us about home office expenses, if any, and this would ultimately determine. So if the individual, let's say, had home office expenses of $70,000, all $70,000 would be deductible because the tentative net profit is $75,000. But let's say home office expenses were $80,000. In such case, the home office expenses on line 30 would be limited to this $75,907 because, again, home office expenses cannot reduce net income below zero. So we have nothing to worry about as it relates to home office in this problem. Our net profit is $75,907. And as we see, we have net profit. This amount would be transferred to Schedule 1, Form 1040, line 3, and on Schedule SE, line 2. So this brings us to the end of the exam review questions for Chapter 1, which covers the individual income tax return, Chapter 2, which covers gross income exclusions, and Chapter 3, which covers business income and expenses.